Hi everyone, welcome to our vlog. We're going to talk about how to determine your tax rate.
So we're going to talk a lot about personal level and taxes at the personal level, because a lot of pass-through entities and small businesses have all their activity reported on their personal income tax return. But there also is a component of the C corporation that has a tax rate. And currently, what's the C corp rate?
C corp rate is 21%, and for states and locals and cities, they have their own tax rates, which vary and could be a flat rate or depending on levels of income. So you'll have to check the state or states, cities that you operate in to determine those rates.
Yeah. So when we talk about the tax rates, we're going to talk about first we'll talk about the federal rate. And the federal rate is considered to be an ordinary tax rate. And a little bit about the way that the tax structure works is there are basically ranges of income that have different tax rates, and they step in amounts and percentages when they are over the top of the range,
right,
moving into the next range.
Yeah, so the IRS, you operate individually via tax bracket. So each tax bracket has its rate, and once you get over that rate, the top of that, as Michelle said, you go to the next level rate. And those income levels adjust each year due to cost of living and inflation changes.
And the IRS, or I guess it would be Congress, they pass different rates depending on that particular tax year. If they're changing some of the tax law, they might change some of the ordinary rates as well.
Yeah, so currently the top tax rate is 37%. So, once your income reaches that level, anything over that is subject to that 37% rate. So it's not all of your income below that level is subject to that. It's whatever is within that bracket or that range is taxed at that rate.
Right. So you get a little bit of the bracket at 0 or 10%, a little bit at the next bracket, a little bit at the next bracket, and so on. And then that is how you identify or get your total tax that's due. The effective rate is a blend of all of those rates all put together. But then there's an added layer of complexity, and this is capital gains.
Yeah, capital gains are taxed at different rates. So it's 0%, 10%, or 20%. So depending on the level of your income, generally we see it mostly taxed at 15%.
Yeah, absolutely. And so that would be the long-term capital gains that is taxed at that. There are short-term capital gains, and short-term capital gains are basically taxed at ordinary rates.
Right.
So there is no added benefit to those gains other than you are able to offset those gains with losses in the same bucket, let's just say.
Right.
So, we're not going to get into how much of those losses you're able to get. That's a whole different vlog. But just know that, there are short-term and long-term, and there are different rates for both of those.
Correct. Yeah. So in addition to long-term capital gains and those different rates, there are other types of taxes for different types of income.
Okay. So we see this a lot in when someone sells real estate. A great example is when someone has purchased a building, let's just say a building or a house that they're renting, and they depreciate that structure, not the land, but the structure. And then they go and sell it. So any gain that you recognize on that sale, there is a component that has to be recaptured because of the depreciation. And that's considered unrecaptured 1250 gain. You don't need to know that. All you need to know is that there is a component in this sale that has a different tax rate.
Right. And that rate is 25%. So if you're in the 37% bracket, you only are going to pay 25%
on that portion of the gain. And then there could be some long-term gains as well within that same transaction.
Correct. Yeah. Additionally, certain dividends that are considered qualified dividends, they they qualify for the long-term capital gain rate. So when you get your 1099, you see an amount for dividends in one box, and then there's qualified dividends. Just know that qualified dividend is subject to capital gain, long-term capital gains rates.
So again, that could be a 0, 15, or 20% rate.
Right.
Then you run into state taxes, and all depending on your state, states could have flat taxes, they could have graduated taxes, kind of similar to the federal. Typically, the states do not have the same percentages that the federal taxes, and federal is always one of your highest taxes that you pay. But your states do sometimes have graduated tax rates or brackets like we talked about in the federal side.
Yeah, and also some states will tax different types of income differently. It's similar to like long-term capital gains rates or the qualified dividend.
Right.
So, you really it's just going to depend on where your income is coming from, where you live, as to what type of taxes you're going to incur in those states and locals and cities.
Yes. Yeah. So we hope that you like this vlog today. Please like and subscribe to our YouTube channel. We are also publishing a masterclass, and that can be accessed at moderncpaonline.com/masterclass. Thanks, guys, and take care.
Bye, everyone.